Hi, I'm Greg McDonald from LodeRock Research, and this is our CEO interview series. Today we're privileged to have in our studio David Taylor, CEO of VersaBank. David has a lengthy and impressive resume in Canadian banking, but what he's most known for is his love of technology, and this has driven him to create a very unique financial services company. VersaBank is a Schedule A Canadian bank, but unlike its big bank counterparts, it has no bricks and mortar. Rather, it sources deposits and distributes loans entirely through technological means, which gives it a much higher than average margin and growth profile. With that as an intro, let me welcome David.
Well, thanks, Greg. It's my pleasure to be here.
David, let's start with technology. It's pretty clear to me that this bank thinks of technology as a competitive advantage. How is that?
Well, the bank started as a software company, and we decided we'd utilize technology to access markets that would otherwise be unreachable through the traditional branch network. We came up with the idea of having partners that would be at our interface with the public. So VersaBank virtually has no interaction with the end customer. That's all done through a partner network.
And the technology itself is of benefit to those partners, which gives you some pricing power with them.
Oh, absolutely. It allows our partners to communicate with us on a daily basis, i.e. they send loans and leases to us electronically each day. Seamless interaction with us, a good place to warehouse their loans and leases as they develop them.
This is developing into some pretty good scale for the bank. In the most recent quarter, in fact, you grew your loan book by an incredible 46%, and point of sales as a loan segment within that grew another incredible 68%.
It's almost infinitely scalable. We rely on technology for all our processes and very little reliance on actual, I call them bio units, the people. So we can grow exceedingly rapidly, but not lose a handle on the credit risk. The new product we created some time ago called the point of sale program is the driver. It's providing consumers and small businesses with the convenience of being able to access financing at the point of sale. It's something that's become more and more popular in Canada, and south of the border is already very, very popular.
So what types of products? People think point of sale, you're thinking things you buy, whether that's a motorcycle or something like that. Is that what is making these loans up, or is it skewing to other?
No, it's actually all items that are purchased at the point of sale. So that ranges from hot water heaters, motorcycles, hot tubs. But the big driver in the last while has been home improvement. And it's what you'd expect, particularly on the energy side. And we're happy that our partners are able to provide the financing and, of course, sell the loans and leases to us.
And one would think that a fringe benefit of that shift would be home improvement loans are probably less risky than motorcycle or hot tub loans. Is that true?
Yeah, that's exactly right. We've been blessed in that consumers are quite rightly looking to save energy bills. I want to improve their home's efficiency. And the consumer credit risk tends to be a lot less than the young fella like me when I was younger buying a new motorcycle.
Is this growth really sustainable?
Canadians are still adopting the point of sale program. So in Canada, it probably is for some time, but sooner or later we would run out of growth. This type of growth in Canada would saturate the market. So we look towards the United States, where point of sale is well developed, well accepted, way more than in Canada actually. And the market is not just proportionally larger as you'd expect, it's probably 10 times that. So maybe 100 times bigger than Canada. Our product that we prototyped here in Canada, we tested out in the United States and very well received. And in fact, happily, the net interest margin that we're able to earn in the United States was a good 1% higher than we could earn in Canada. So of course, we're going to the United States.
Investors and analysts like myself sometimes would look at very strong growth like a plus 40%, or in the point of sale case, plus 60% or almost 70%, as coming with higher risk. How does the technology address risk?
In the past, and I've been a banker now 46 years, rapid growth in the banking portfolio always spelled higher risk. The systems just didn't keep up with it. You couldn't keep a handle on the portfolio. It was just growing too rapidly. But with the use of technology, we have a very deep insight into the loans that are being put on. So technology has enabled us to grow super fast, but not lose our handle on the risk profile.
So this is as much a technology company as it is a bank, it seems.
That's its foundation. It was a technology company, and we've embraced technology wherever it may be that serves the bank's purpose. Case in point, that we created a cybersecurity firm to look after the bank's cybersecurity. DRT Cyber is that cybersecurity firm. And not only does it provide the cybersecurity for our bank, we now provide the cybersecurity for a lot of high-value enterprises throughout North America, railway lines, police departments, energy companies, and such. I was really lucky in that the head of BlackBerry's cybersecurity, Gurpreet Sahota, who had kept BlackBerry safe for 14 years from hacking, joined up to head up this operation for us. So we believe we have a first-class cybersecurity firm, keeping our bank safe, and now we're keeping other banks and other high-value enterprises safe too.
Let's shift to the stock. Bank stocks in the last year or so have been underperforming a little bit, and that's just because the market itself is recognizing there's a possibility of a recession, there's a possibility for reserves having to go up, and there's a possibility for loan volumes to go down. You're clearly bucking that trend, as the evidence shows in the most recent quarter. What do you think the market's missing on your stock?
Well, at this point, they probably think it's unbelievable. They just probably haven't realized that our bank does better in recessionary times than in buoyant times. I've often said to our lenders, bad loans are made in good times. When a recession is on its way, or times that things have slowed down and the other banks' portfolios are starting to show cracks, because we've adhered to a very low credit risk strategy, our portfolio doesn't show cracks. And that enables us to keep right on lending and probably make new relationships much more quickly than we would otherwise when things are going well.
David, I want to thank you for being here, for providing such a unique perspective on fintech and how VersaBank is leveraging these themes.